Welcome. Today, we're diving into the world of financial markets, institutions, and the innovative instruments that keep our economy moving. Financial markets are not always a physical place, rather, they're systems or arrangements that facilitate the buying and selling of financial assets. Whether it's trading shares on a stock exchange or depositing money in a bank, these transactions are all part of the financial market ecosystem. Understanding how these markets operate is crucial for anyone interested in economics, business, or personal finance. Let's start by exploring what financial markets are and why they matter in our daily lives. Financial market is any arrangement that allows people to buy and sell financial assets such as stocks, bonds, or loans. These markets play a vital role in the economy by connecting those who have surplus funds with those who need capital. For example, when a company issues equity shares, the stock exchange acts as the financial market. Similarly, banks serve as markets for loans and deposits. Financial markets are essential for economic growth, providing liquidity and enabling efficient allocation of resources. Financial markets can be classified in several ways. One common method is based on the time period of the financial assets traded. Here we have two main categories, the capital market and the money market. The capital market deals with long-term or indefinite maturity assets like shares and debentures, while the money market focuses on short-term assets with maturities up to 1 year, such as treasury bills and commercial papers. This distinction helps investors and businesses choose the right market for their needs. Capital market is where long-term financial assets are bought and sold. This includes shares, debentures, and government securities with maturities longer than 1 year. Companies and governments use the capital market to raise funds for long-term projects and expansion. Investors participate in the capital market to earn returns over a longer period. Examples of capital market instruments include stocks, bonds, and gilt-edged securities. Money market is designed for short-term borrowing and lending, typically for periods up to 1 year. It deals with highly liquid and low-risk instruments such as treasury bills, commercial papers, and certificates of deposit. The money market is crucial for managing the day-to-day funding needs of businesses and governments. It provides a platform for institutions to quickly raise funds or invest surplus cash for short duration. Another way to classify financial markets is by their structure. Organized markets are regulated and follow standardized rules, often overseen by regulatory bodies like the RBI, SEBI, or IRDA. These markets offer transparency and protection for participants. Unorganized markets, on the other hand, consist of money lenders, private finance companies, and chit funds, operating without strict regulatory oversight. While organized markets are safer and more reliable, unorganized markets still play a role in meeting certain financial needs. Organized financial markets are characterized by strict rules and regulations. These markets are monitored by government agencies to ensure fair practices and protect investors. Examples include stock exchanges, government securities markets, and regulated banking institutions. The presence of regulatory bodies like the RBI and SEBI ensures that transactions are transparent and participants are safeguarded against fraud or malpractice. Unorganized financial markets operate outside the purview of formal regulations. These include money lenders, private finance companies, and chit funds. While they provide quick access to funds, especially in rural or underserved areas, they often lack transparency and can charge higher interest rates. The activities in these markets are not supervised by regulatory authorities like the RBI, making them riskier for borrowers and investors. Financial markets can also be classified based on the type of financial assets traded. The two main categories here are the debt market and the equity market. The debt market is where long-term borrowings like bonds and debentures are bought and sold. The equity market, on the other hand, is where shares of companies are traded. Each market serves different needs and attracts different types of investors. Debt market is a platform for trading financial assets like bonds, debentures, and other long-term borrowings. Investors in the debt market are typically looking for steady, predictable returns with lower risk compared to equities. Governments and corporations issue debt instruments to raise funds for various projects, and investors purchase these instruments to earn interest income over time. Equity market is where shares of companies are bought and sold. Investors purchase equity shares to become part owners of a company and potentially benefit from its growth through dividends and capital appreciation. Major stock exchanges like the BSE and NSE in India facilitate these transactions, providing a transparent and regulated environment for trading. Another important classification is based on the stage of securities being traded. The primary market is where new securities are issued and sold to investors for the first time. The secondary market, on the other hand, is where existing securities are bought and sold among investors. Both markets are essential for the smooth functioning of the financial system, providing capital to businesses and liquidity to investors. Primary market is where companies and governments issue new securities to raise capital. Investors purchase these securities directly from the issuer, providing fresh funds for business expansion or public projects. The primary market is crucial for economic development, as it channels savings into productive investments and supports the growth of new enterprises. Secondary market is where previously issued securities are traded among investors. Stock exchanges like the BSE and NSE are prime examples of secondary markets. These markets provide liquidity, allowing investors to buy and sell securities as needed. While the secondary market does not directly supply new capital to companies, it plays a vital role in maintaining investor confidence and market stability. Financial markets also include specialized segments like the foreign exchange market and the derivatives market. The foreign exchange market is where currencies are traded, involving banks, brokers, and dealers. The derivatives market deals with financial instruments like futures and options, which derive their value from underlying assets such as stocks, commodities, or currencies. These markets help manage risks and facilitate international trade. Money market offers a variety of instruments for short-term borrowing and lending. These include commercial papers, commercial bills, certificates of deposit, money at call, treasury bills, and repo instruments. Each instrument serves a specific purpose, catering to the diverse needs of businesses, governments, and financial institutions. Let's take a closer look at each of these money market instruments. Commercial paper is an unsecured promissory note issued by companies to raise short-term funds. It is typically issued at a discount and redeemed at face value on maturity. Only companies approved by the RBI can issue commercial papers, and they are negotiable by endorsement and delivery. Investors in commercial papers include individuals, banks, corporates, and NRIs. These instruments are popular due to their flexibility and relatively low risk. Commercial papers are short-term money market instruments, usually issued for periods ranging from a few days to 1 year. They are unsecured, meaning they are not backed by collateral and are issued at a discount to face value. The issuer promises to pay the holder a fixed amount on a future date. Their negotiability and ease of transfer make them attractive for both issuers and investors. Certificates of deposit (CDs) are short-term deposit instruments issued by banks and financial institutions to raise large sums of money. CDs are negotiable and can be transferred from one party to another. They are issued at a discount and repaid at face value on a fixed date. CDs are popular among investors looking for secure short-term investment options. Certificates of deposit are unsecured promissory notes that are freely transferable by endorsement. They are issued at a discount and repaid at face value on a specified date, without any grace period. CDs are considered short-term money market instruments and are widely used by banks and financial institutions to manage liquidity and funding needs. Treasury bill market deals with short-term government borrowings. Treasury bills are issued by the RBI on behalf of the government to meet temporary funding needs. They are highly liquid and considered safe investments due to government backing. Treasury bills are issued at a discount and repaid at face value, making them attractive for investors seeking security and liquidity. There are two main types of treasury bills: ordinary or regular treasury bills and ad hoc treasury bills. Regular treasury bills are issued to the public and financial institutions to meet the short-term financial requirements of the central government. Ad hoc treasury bills are issued specifically in favor of the RBI. Both types offer high liquidity and safety, making them a preferred choice for conservative investors. Commercial bills market is where bills of exchange arising from trade transactions are bought and sold. When a seller extends credit to a buyer, a bill of exchange is drawn, which the buyer accepts and promises to pay at a later date. The seller can discount the bill with a bank to receive immediate payment. This market provides liquidity to businesses and supports trade financing. Bill of exchange involves three parties: the drawer who creates the bill, the drawee who accepts the bill and promises to pay, and the payee who receives the payment. Sometimes the drawee and payee can be the same person or a bank. This structure ensures clarity and security in trade transactions, making commercial bills a reliable instrument in the money market. Money at call market deals with extremely short-term loans, typically ranging from 1 day to 19 days. These loans are highly liquid and can be repaid on demand by either the lender or the borrower. In India, call money markets are closely linked to stock exchanges and are found in major industrial cities. The interest rates in this market fluctuate daily, reflecting changes in demand and supply for funds. Repo or repurchase agreements are short-term borrowing arrangements where a security is sold with an agreement to repurchase it at a higher price on a later date. Dealers in government securities commonly use repos to manage liquidity. The central bank also uses repos as a tool to regulate the money supply. These agreements are typically backed by government securities, making them low risk and widely used in the money market. Capital market is essential for raising long-term funds. Companies and governments use it to finance large projects and investments. The capital market consists of the bond market and the stock market, each serving different needs. The primary market handles new issues while the secondary market deals with existing securities. Together, they ensure a steady flow of capital for economic growth. India's capital market is divided into organized and unorganized sectors. The organized sector includes securities markets and term lending institutions like RBI banks and non-bank financial intermediaries. The stock market is a key part of the organized sector, offering a platform for trading various securities. The unorganized sector consists of indigenous bankers, money lenders, and other informal financial institutions. Gilt-edged market refers to the trading of government and semi-government securities, which are considered highly secure and backed by the RBI. These securities are popular among conservative investors seeking safety and steady returns. The gilt-edged market plays a vital role in funding government projects and maintaining financial stability. Industrial securities market deals with the trading of equities and debentures of both old and new companies. It is further divided into the primary market, where new securities are issued, and the secondary market, where existing securities are traded. This market supports the growth of industries by providing access to long-term capital. Capital markets serve as intermediaries between those with surplus capital and those in need of funds. They aim to achieve efficiency in transactions, support economic growth, and ensure the continuous availability of funds. By minimizing transaction and information costs, capital markets help boost national income and promote productive utilization of resources. Capital markets are venues where savings and investments are channeled between suppliers and those in need of capital. The main participants include retail and institutional investors, businesses, governments, and individuals. Capital markets are primarily divided into the primary market for new issues and the secondary market for trading existing securities. Primary market is where companies raise new capital by issuing shares or debentures to investors. This market is crucial for funding business expansion and supporting economic development. Investors in the primary market purchase securities that have never been traded before, providing fresh capital to issuers. Secondary market is where existing securities are bought and sold among investors. Stock exchanges play a central role in the secondary market, providing liquidity and enabling investors to adjust their portfolios as needed. While the secondary market does not directly supply new capital, it is essential for maintaining investor confidence and market efficiency. Stock exchange is an organized marketplace where listed securities are bought and sold. It provides a transparent and regulated environment for trading, ensuring fair prices and protecting investors. The stock exchange is vital for the functioning of the secondary market, offering liquidity and facilitating capital formation. The unorganized sector in the capital market includes indigenous bankers, money lenders, chit funds, and other informal financial institutions. While their role is not as significant as the organized sector, they still provide financial services to certain segments of the population, especially in rural or underserved areas. Money markets and capital markets serve different purposes. The money market provides short-term credit facilities, dealing with instruments like commercial paper, certificates of deposit, and treasury bills. The capital market, on the other hand, offers long-term credit through stocks, bonds, and mutual funds. Money market instruments are low risk and highly liquid, while capital market instruments offer higher returns but come with greater risk. Financial institutions are organizations engaged in financial and monetary transactions such as deposits, loans, investments, and currency exchange. They play a crucial role in economic development by offering a range of products and services to individuals and businesses. Financial institutions can be government-owned or private, and they support industrial and economic growth. There are two main types of financial institutions: banking institutions and non-banking financial institutions. Banking institutions include commercial banks, central banks, regional rural banks, public sector banks, and specialized banks. Non-banking financial institutions provide banking-like services without meeting the legal definition of a bank, mobilizing financial resources directly or indirectly from the public. Banking institutions are the backbone of the financial system. They include commercial banks which accept deposits and provide loans, central banks which regulate the money supply, regional rural banks which serve rural areas, public sector banks, and specialized banks catering to specific sectors. These institutions ensure the smooth flow of funds in the economy. Non-banking financial institutions, NBFIs, provide financial services without being classified as banks. They include provident funds, pension funds, mutual funds, money lenders, insurance companies like LIC and GIC, merchant banks, and venture capitalists. NBFIs play a significant role in mobilizing savings and supporting investment in the economy. Financial institutions support economic development by offering a wide range of products and services. They provide credit, facilitate investments, manage risks, and ensure the efficient allocation of resources. By supporting industries and individuals, financial institutions contribute to overall economic growth and stability. Financial innovations refer to the development of new financial instruments, technologies, and processes that improve the efficiency and effectiveness of financial markets. Examples include derivatives, electronic trading platforms, and innovative lending models. These innovations help manage risks, reduce costs, and expand access to financial services. India has undergone significant financial sector reforms, guided by recommendations from committees like the Narasimham Committee. These reforms have aimed to strengthen the regulatory framework, enhance transparency, and promote innovation in the financial sector. As a result, India's financial markets have become more robust, competitive, and accessible to a wider range of participants. In summary, financial markets, institutions, and instruments form the backbone of any modern economy. They facilitate the flow of funds, support economic growth, and drive innovation. Understanding how these components interact helps us appreciate the complexity and importance of the financial ecosystem. As markets continue to evolve, staying informed about financial innovations and reforms is key to making sound financial decisions.